was pretty interesting. What'd you think? Yeah, not bad, right? I mean, who knew all that stuff was going on at the intersection of tokenization and private credit? I certainly had no idea. So the next panel is interesting. I don't know if you guys have been reading the paper, but it seems like every stock exchange is looking to launch a new tokenized ATS, tokenized stock trading platform. And that, for some reason, has made the transfer agent the hottest commodity on Wall Street, which at first glance seems pretty strange because it sounds incredibly boring. So we'll be talking about that and the efficiencies that tokenization unlocks for the markets. Anyone who's tried to move shares off a platform to a different one has experienced this. I recently was trying to move funds from Fidelity to Morgan Stanley, weeks of paperwork, calls with bankers. It's a nightmare. So apparently tokenization helps fix those issues, and we're going to talk about that in the next session. We've got some great people. One guy almost missed his flight from Charlotte to Newark to make it here, but he's here, and we'll introduce them all on stage now. Gentlemen, come join us.
Right, I hope you're all doing very well. Tokenize this. Give a round of applause to our fantastic guest over here. Beautiful. I'm Marcin, I'm one of the co-founders of Redstone Oracles and Credura Ratings. We are hosting this year Tokenize This after the acquisition. Truly, truly glad that it's such a great event and the biggest one so far. Today we are going to talk a bit about operational efficiencies in tokenization. So 3 years ago, real-world assets on chain were a rounding error, as we know. Today, there are over $31 billion of them, 6 times more than at the beginning of 2025. The promise behind those numbers is operational, settlement in seconds instead of days, collateral that moves 24/7, reconciliation handled by code instead of back offices, and true programmability of money. However, what we see today is very little usage of tokenized real-world assets in on-chain logic as collateral and actual utility. People put it on-chain, but not much is happening. There are a few blockers and obstacles to do it efficiently, and today we're going to talk about it. So maybe we can start with short introductions from our panelists. Can you tell us a bit about yourself, your company, and in one sentence, where does your company sit in the tokenization stack? So Joseph, why don't we start with you?
I might do more than one sentence, if that's okay. Joe Spiro here. I'm with DTCC in our Digital Asset Solutions team. DTCC, for anyone not familiar, is the holder of record of most of the United States assets market. We custody around 100 trillion in assets. That's more than 99% of the US equities market and a good chunk of the fixed income market as well, processing transactions on the order of about 4 quadrillion annually with a Q. So our goal, our publicly stated goal, is to tokenize all of it. That's your question, where do we sit in the stack? We're the world's biggest infrastructure provider, and the goal is to bring that same level of safety, security, and trusted infrastructure to the digital market as well.
Hi, everyone. So my name is Greg Cignarella. I lead the U.S. broker-dealer ApexInvest Markets. This is a subsidiary company of the fund administrator Apex Group. We were acquired. I was part of Tokeny, head of Americas, roughly a year ago when we were acquired by Apex. Apex at the time was an investor in the firm that took majority interest last year. No sooner did I enter the doors at Apex that they chose to acquire a broker-dealer. This was meant to commercialize and build out the cap intro business that they already had. So I spent about all of 30 seconds in the digital seat within Apex until I was asked to lead the broker-dealer, and it's been a build-out effort to get it to where it is today, but also make it DeFi capable in addition to its existing membership agreement for private market primary distribution and secondary trading. Where it sits in the stack is the broker-dealer licenses its technology from Tokeny, which is part of a division of Apex called Apex Digital, which was also founded a little less than a year ago. So it's really meant to build out all things having to do with asset tokenization and blockchain solutions throughout the company. This, to take one more second, a fund admin, you can't get any more TradFi than that, and the industry largely remains on those same rails that it's always existed on for decades. Where Apex took a bigger step in acquiring Tokeny and utilizing its technology over the last few years is to take these traditional rails and put them on a digital ecosystem as well. So now it's actually one of the few companies that can provide, whether it's fund admin, transfer agency, or any of the other services it provides, but both doing it on a traditional rails as well as digital. I'll stop there.
Brilliant. Joris, why don't you go next?
Yeah, hi everyone. I'm Joris Delanoue. I'm the CEO and co-founder of Fairmint. At Fairmint, we bring equity on-chain. We turn cap tables into smart contract with one goal, making the entire asset, the share, as programmable as possible, so that we can then embrace the whole world of composability. We've been operating Fairmint for the last almost 8 years now. We have close to $2 billion of assets through our smart contract. And we are literally blurring the line between the private and the public market, facilitating the way company can access to capital through capital formation on chain, as well as tender offers and anything that will make those shares that are traditionally very illiquid in the off-chain world to become an asset that is effectively easier to move once it is on chain.
Brilliant. Last but not least, Peter.
Thank you. Good afternoon. My name is Peter Duggan. I'm Executive Vice President at ComputerShare. ComputerShare is the world's largest transfer agent and registrar. In the US, we have over 3,000 public companies that we record keep for. I have over 30 years experience in the securities processing industry, and for the last 4 years, I've also been the president of the Securities Transfer Association, which is the industry organization in the US for transfer agents. And my focus here today and at ComputerShare right now is tokenizing public equities. And we recently announced a partnership with Securitize to help us mint and deliver those tokens on behalf of our public issuer clients.
Fantastic. All right. So as Redstone, we are an Oracle provider, one of the largest in the world, protecting over $10 billion, working with 200 clients across over 100 chains. Securitize chose Redstone as the official and primary Oracle for all tokenized assets, including BlackRock, Biddle, Apollo, ACRED, and so on. So we are very much into the stack of like what the gentlemen are representing. But let us go into the efficiency and questions where it's real on chain. So Joseph, you're planning to tokenize collateral and DTC custody treasuries starting with Canton and Stellar. Those are like public information already. Where does tokenization remove the most cost and risk today? Is it on the settlement and reconciliation or collateral mobility? What's still hard in that regard?
All of the above. Yeah, so as you kind of alluded to, DTCC is not, selecting, one blockchain to rule them all. We're meant to be a multi-chain strategy where, as a market-neutral infrastructure provider, we can tokenize onto the blockchain of our clients' choosing. We've announced collaborations with Canton, with Stellar. We also have a private permissioned instance of Hyperledger Besu where we're hosting our collateral app chain. All three of those chains are going to be part of the tokenization service to start, but it certainly won't end there. We fully expect, any public or private chain that our clients direct us to be able to tokenize on that chain. One of the ideas here is to facilitate interoperability. And to your point of efficiency, you can't be efficient unless you have easy, quick interoperability. both between traditional financial systems as well as on-chain digital financial systems and between blockchains. So part of the DTC tokenization service is the ability to quickly and easily transform from traditional form into tokenized form and then back again, so you don't lose any of the benefits and deep liquidity in the traditional market. Once you tokenize your asset, you're not just in the digital world forever. You can go back and forth. And then once you're on chain, you can move to another chain to facilitate a use case there just as easily. Where is the biggest efficiency? I think a lot of people have talked about collateral. I'm a collateral practitioner by trade. I'm a lifelong collateral guy. So when I think about, the benefits of, in the legacy world, it's, 2:30 p.m. New York time, and the Fed goes down at 3, and where are my treasuries? And oh my God, get me a Fed reference number. I have to figure out where it is, and can I reconcile, who's failed to me and who hasn't, and where all my assets are that were supposed to settle yesterday. That goes away, okay? If the blockchain becomes an extension of your ledger, and it's an extension of your counterparty's ledger, there's a single ledger. Reconciliation is not easier, it's irrelevant, because you don't reconcile the same ledger to itself, right? Reconciliation is necessary when you have two ledgers trying to come together. If it's a single ledger, then that's the record. And the tokenizing the assets doesn't get you there immediately, but it enables that solution, right? It enables 24/7 instantaneous settlement, which will facilitate real optimization of assets, which can have tremendous capital cost reduction. It will facilitate risk reduction by reducing your margin period of risk to 1 or less, 1 T plus 1 minute, right? All these things are possible when you can bring those assets on chain. So whether it's on the Canton network, on the Stellar network, on our collateral app chain, where you have the terms of your collateral agreement written directly into the smart contract so that it's programmatic. The efficiencies from an operational perspective are really easy to see. They're very obvious.
Brilliant. I love the take that reconciliation is obscure word, like when you have just one ledger, right? So going forward, Greg, so the industry claims 30% lower post-trade costs and settlement from days to seconds. What, in your opinion, is real versus still a pitch with not much data backing it?
Well, okay, so let's, what I didn't say earlier was prior to my time joining Tokeny, it was 3 decades, I'll stop at that number, where I was actually in capital markets, sales and trading, predominantly fixed income and some private investments as well. Well, for all those years, when you're sitting on the trading floor and you're executing transactions, now again, it was fixed income, very liquid, very fast, lots of records, lots of transactions. But as we were saying a moment ago about the ledgers, everybody just, everyone operated on individual ledgers, and it was normal. It was awful because all the post-trade activities, which, you'd like to think I didn't get involved in, because once I said done, we had a whole other team of middle and back office people to work out these issues. But invariably, it gets back to us because I can't even count the number of times the counterparty didn't know, the DKs we used to have to deal with. We talk about reconciliation and all the different parties in between, right? Now we're only talking about the counterparties, but then you've got those other infrastructure partners, whether it be custodians and transfer agents and prime brokers and all the different pieces in between, where everybody's got to reconcile to their own ledgers. So, and these fails that occur afterwards, this is a major cost to the industry. We keep on hearing this 30% number thrown about in cost savings. Now, okay, that's in a way a little bit of a fictitious number because it could actually be much higher. So if you just toss out the reconciliation issues by bringing everything on chain and you throw off the failed trades, well, that could be 30%. Now, this isn't going to happen anytime soon where we're going to eliminate those infrastructure partners. In fact, the acceleration of this industry under current regulations depend on those infrastructure players being in place, just being able to handle digital instruments, which is why I was saying Apex has jumped on that because they see where the future is going and they want to be they want to future-proof the business. So that's where it's all about. But in time, hopefully sooner rather than later, but it's going to take some time, that the market determines that those partners in between just kind of go away over time. Then the cost savings really start magnifying. Then you could think of, $100 billion in cost savings. I think that's almost the number that's bantered around. If you eliminate that entire stack of what we have to deal with now in the post-transaction TradFi world and the costs it has in the industry, that's the number you hear about. So 30% I think is a conservative number, but it's a fair number with the things that could be eliminated earlier, which is reconciliation and fails. The rest is going to take time, but naturally, in order to eliminate that, you need instruments on the rails and trading in this manner, which we know is also going to take time. But just like what we saw in the adoption of the internet in the 90s, which took some time, this adoption is taking place. I'm sure we're going to talk about in a moment what instruments we're seeing active on the blockchain today. But we're not having this conversation in 5 years from now. I think it's just the nature of how the market's going to operate.
Exactly. As we see also the trend of growing RWAs. We started with 5 billion in 24, 21 billion in 25. Now it's 31 billion, and the proliferation is going to only happen in the years to come, especially if Clarity goes through, right? Going forward, Joris, you're an SEC registered transfer agent, but you put equity directly on chain on Canton. Where is the real efficiency in programmable equity versus a traditional register, and what still needs a human and legal layer?
So yeah, we've been a transfer agent with Fairmint since 2023. At that time, transfer agency was not very sexy. It seems that it's way more sexy today. The thing that matters when you are an issuer, when you create your company and you start issuing shares for yourself as a founder, for your first investors, for your employees, and anyone that will participate in developing the company is you want to make sure that you know what you own. And we started on our end with the private companies. We wanted to make sure that accessing to the equity, whether it's by investing or just receiving them as a grant, would be easier. But also, we wanted to make sure that the moment that you own those shares, you don't really care who are the people managing the cap table itself, because today it's extremely complex when you're a private company to deal with all those shares. It is much easier when the company go public, because once it's public, you have less class of shares, you have less, the waterfall happened already. But when you're private, round and after round, there is a lot of complexity to deal with, especially with convertible instrument. So 4 years ago, we started to work on an open standard with top US securities law firm, Gunderson, Cooley, Oric, Latam, and some of the top cap table vendors, Carta, what's the other name, AngelList, and all the other players that were managing cap tables, to make sure that from a day to another one, we would move to a world where everyone would talk the exact same language, where every single securities would be standardized. And this work is actually a good reminder of what happened in '69 when the paper crisis happened, and when literally Wall Street had to close on Wednesdays to make sure that they were able to reconciliate everything that was paper-based. And one of the direct consequences of this paper crisis has been the DTCC as the centralized agent to guarantee trust for the markets. But at that time also, there were also some other opportunities to build a more distributed network for transfer agent in a way that would allow every single issuer to rely on his transfer agent and deposit his own asset there, and every transfer agent would interpret all together. The problem at that time is the technology was not the right one. We had mainframe, perfect for centralization, but we didn't have DLTs as we have them today that are absolutely awesome when it comes to create interoperable network. And so right now, this is what we are on, and I think this is one of the big challenge and also biggest opportunity for the market, because we have this opportunity to rewire the way things works today thanks to DLTs. Tokenization is not the destination. The reality is, how do we make sure that every single asset has a single source of truth, as Joe was mentioning it, and is this source of truth commonly shared? Who are the people able to interact with this source of truth? Because if we are able to do that, then we get a chance to keep trust while evolving the market completely. And so this is why I said earlier we are blurring the line between private and public. We start from the private side, and we keep onboarding more and more issuer companies that are leaning to IPO tomorrow, with one simple goal: making sure that everything is structured so that the day they go public, whether it's a very small float or through a SPAC, through a direct listing, or a traditional way, their shares will be widely accessible, and we will be able in a minute to offer the issuer the all transparency that they expect and that they had when they were private. Because today, if you are issuing shares to your shareholders, when you are a private company, you can, in a minute, literally export and get a snapshot of who owns what in your company. The moment that you go public, you lose that. Why? Because we are in a world where, to guarantee trust, we need compliance by intermediation. And today the challenge is to bring compliance by automation. Who will be the winner in this game? We were chatting about it just before, but it seems that transfer agencies is precisely where a lot of the work and effort should be done to guarantee that trust in today's DLT's work.
Brilliant to also get this kind of like a historical perspective, like from the 60s up to now. And it's a progress. It doesn't happen like overnight. And the transfer agent role undoubtedly is a big one and potentially like getting even bigger. So Peter, passing to you as the official record keeper, how does an issuer-sponsored token change cap table and corporate actions work, and what breaks if the on-chain record and the legal register even diverge?
I have to start by saying it's very exciting for someone who's been in the transfer agent business most of their career. Suddenly, transfer agency is sexy. Nobody wanted to talk to us for years. So let me just tell you what ISTs are. And ComputerShare, through its predecessors, ComputerShare bought the Bank of New York Mellon and a number of other businesses. We date back in the transfer agency business to the late 1800s. So we've been doing it for a while. But again, the focus on the public side. So an issuer-sponsored token is not a wrapper. It's not a share held in custody and then a separate security issued to represent it. It is the stock of the public company. And today, you can be a registered shareholder in a US public company, and you can potentially hold your stock in a physical stock certificate. They are still around, believe it or not. Or you can own your shares in what we call book entry, DRS form, where you don't have a certificate, but you're on our register with your name and address and the number of shares that you own. Or you could, and that book entry DRS connects to the DTC system, so you can move in and out of DTC and in and out of a brokerage account. The IST, the token, is just adding another form of ownership. So now an investor can own shares in a public company in token form, in a wallet, on a public blockchain where they might be holding other digital assets. They can now have a public company in that wallet as well. But the issuing company has to decide they want to do it, offer it, they have to offer the ability, and then the shareholder has to decide that's the form of ownership they want to have. So back to the cap table question, I think one of the misconceptions as it relates to public equity is that it's a separate class. It's not a separate class. It's not a separate, it's not new capital being raised, although it could be. It could be an IPO, there could be a secondary offering, but let's just assume for now the IST for most public companies will be their existing cap table just moving from either a certificate form or from a book entry DRS form, or even out of a brokerage account, out of DTC, onto the register, through the transfer agent, and then into token form. So it is the security. It has all of the rights: dividends, corporate actions, proxy. Unlike some of the wrappers where you have to look to see which rights are being passed through, the owner of an IST, the shareholder, is 100% all the same rights as any other shareholder on the register for that company. Now, the second part of the question had to do with was it the discrepancy?
Discrepancies, exactly.
Discrepancy. So what's also interesting, within ISTs, there's two forms of record keeping. The token can either be an instruction token, where when you move from one wallet to another, you're basically sending the transfer agent an instruction to say, please do a transfer. I want to transfer my shares to my neighbor. But when that happens, it's an instruction, it's not the security, and you don't have legal certainty when you move the token from one wallet to another. If you're doing a private sale, you don't have the legal certainty because you have to wait for the transfer agent books to be updated. The other form of IST, which is the one that Computershare espouses, is where we maintain that the blockchain itself is the form of record. And so the SEC requires transfer agents to maintain what they call the master security file, all the names and addresses and shareholdings of all of the issuers' investors. And traditionally, transfer agents kept all of that on a big mainframe, somewhere in a data center. But if you maintain the component that is tokenized with the personal information, the PI kept off-chain. Nobody wants to expose their name and address and other key information. But if that data is married through the wallet address to the blockchain, then it is part of the MSF. It's part of the master security file. And so that allows the security the token to be a security, that the blockchain is the MSF. It is record keeping the holder position. And therefore, you do have legal certainty when you move shares between wallets. As long as the investor is whitelisted in advance, it's an instantaneous movement into the wallet, and it's an instantaneous update on the books of the transfer agent. So long-winded answer to say you can't go out of proof because it's not that a separate system has to be updated. The chain is the record-keeping system for the token holders.
TA being sexy and cool.
Amazing,
How
isn't
about
it?
that?
It's a good icebreaker in 2026 to say, hey, I have a transfer agent, right? When you're starting the conversation. As an Oracle, we mainly deal around the prices of assets, including the crypto assets such as Bitcoin, ETH, but now growingly RWAs, shares, commodities, FX. Redstone is powering, for example, hyperliquid HAP3, which was a big venue to trade oil when the strikes in Iran happened, and at one point processed up to 2% of CME. And on the Credora side, we look at the risk associated aspects. For example, OPSEC risk. In the past couple of months, we've seen hacks on KelpDAO, Resolve, Drift, an increasing number of those kind of events. So I would like to now shift gears and go a bit towards utilization of those tokenized assets in on-chain logic and as collateral, coming back to you, Joseph. So for a tokenized asset to be usable as this better version of collateral that is accessible 24/7 globally, what has to be first addressed? Is it mainly the settlement finality? Is it legal enforceability? Or maybe price tracing, or all of these in the same moment?
Yeah, it's similar to the previous question. All of those things are important. I've had questions around all of those things. One of the most pressing one is the legal certainty with regard to perfecting your security interest by way of demonstrating the tenet of control, which is what you need in order to use these assets as collateral in most collateral arrangements, at least in the US and Europe. But the pricing one is another big factor as well. One thing that we can definitely agree on is that the method of tokenization is going to have an impact on the price, so much so that if it's just a wrapper or derivative, then the asset itself isn't really the asset itself. You're not pricing the asset itself. If the token that you hold is the security and it is that entitlement to that asset the same way that it would be in the traditional brokerage account, the price should be the same, right? I mean, there may be a difference for the protocol uniqueness of the chain that you're on, but hopefully the price should be the same. So you shouldn't be able to have a big arbitrage between traditional and digital, especially if you have the ability, like we said, to seamlessly move between the two of them. That's important because if you're posting an asset as collateral, you need to have certainty that you can liquidate it the same way you would as if it was a traditional asset. If you're stuck in the digital form and your only option is a DEX that may not have the same amount of liquidity, then the price comes into play a lot. Whereas if you have the ability to transfer it back to the traditional form, then you can take advantage of all the deep liquidity that's in the traditional market right now, which is something that we do really well.
A great example was when Anthropic announced that they are not going to accept secondaries on some of their pre-IPO, let's say, equities. And there was like a protocol on Solana that was a wrapper about their pre-IPO shares that literally dropped like 30% or 40% from the theoretical price that was trading before being liquid on chain in general. With Redstone, maybe I would just also share that we launched a product called Redstone Settle that helps with this primary redemption problem so that you don't need necessarily on-chain liquidity in order to facilitate liquidation of a tokenized RWA that is in Morpho, Drift, or Spark or any other protocol. Greg, you connect allocators and managers. Tokenized treasuries and private credit lead the 26 billion on-chain market. Where is the real institutional demand pulling next, in your opinion? And where is it rather a solution still looking for a problem to solve?
You see, I love this type of question, right? Because, listen, we as an industry, as a group, I mean, we're bearing witness to history in the making that it affects everyone in the world attached to financial markets and as well as investors. So in effect, it's going to change how we move money and how investments are made. It's just amazing, and you'll be able to tell your nerdy grandchildren one day that you were there and here's what you did. And it's an evolution. It's happening slowly but quicker than you think. And as I just said, we're all bearing witness to this. So where we were just a few years ago, not even 2 or 3 years ago, it's a dramatic change in where we are and where global adoption, which can be measured in lots of different ways, and what the conversations we're having 2 years ago from making sure that senior management understood what this was all about. And no, it's not Bitcoin. I had to have that conversation countless times, but just really an understanding of what it is that's being changed here. I mean, at its core level. And again, if you look back over the decades, right, think about where we were in the 60s and 70s with paper-based ledgers, and then it goes electronic, and then you had the internet age. I mean, these are the seismic shifts, and blockchain and what we're doing today is going to dwarf them all. I truly do believe it, and we'll see what happens as the next improvement upon that, which I don't know if I'll still be around to see it, but it's going to be fascinating. So we all should have an appreciation of kind of what we're witnessing right now. Now, when you think about this adoption, well, where is it happening? Sometimes when you speak, it all depends on who you're speaking to. If you're speaking to the buy side, efficiency isn't enough. They need to see growth in AUM. Like, what is the value proposition? And we're stuck with our legacy systems, and we're stuck with the way we've been doing it forever because we've been doing this a long time, and senior leadership is made up of old guys like me, and they're stuck in the way that they do things. But not everyone is certainly seeing a lot of sharper minds kind of looking at the benefits of all this. But then you look at the sell side and the dealer community and fabulous things happening at DTCC and computer shares. I love hearing what you're saying in the markets that I would think would take the longest, right? The liquid markets. So I love hearing what you're saying. In the private markets, this is where the need greatly is, but it's happening slowly. Private credit, I think Christine spoke about it earlier, private equity for sure, whether you do it in an SPV or a fund format. We're seeing projects and for fund managers who are relying on capital calls, that's just giving you one example. The easiest thing is, well, I'm going to tokenize my fund and distribute the shares. All right, fine, but let's go a little bit deeper. Let's explore it. Well, I'm a fund manager and I've got to do capital calls from time to time. Well, 90% come in when I ask, but the 10% doesn't because people move like snails and money doesn't come in what you want. But you can tokenize that receivable and you could borrow against it. And now the fund manager gets his funds, does what he has to do. And these are the wake-up calls that the industry's noticing. Even things like rent roll distribution on a commercial real estate, all that can be put on digital rails. It happens instantly. Push of a button, wallet-to-wallet transfers, people get paid. Where we're seeing a lot of activity, especially on the Apex Digital side, is in what you would think would be somewhat boring, but it's actually where the money is being saved. It's in the liquid cash management side. It's basically taking money market funds. Again, I think Christine talked about this, tokenizing that. It's short-term treasuries. It's things that are being used for working capital, posting collateral, and using money not just to sit there idle, but actually earning yield off of that. That is incredibly important right now. So those are the, and again, you're just now taking capital that's doing nothing that you could utilize elsewhere, but at least now it's yielding. These are the types of projects that you're certainly seeing on the sell side of driving adoption. Tokenized money market funds, the Bitcoin, the Benji coin. Like, this is where you're going to see dramatic shift, and then you're going to see adoption happen thereafter when it comes to the transfer of fund rights or even outright liquid market securities.
Yeah, you cannot chase only the shiny and sexy use cases. The boring ones that are important long-term are the ones that usually are important for the market. Joris, coming back to the price, sorry, I'm obsessed about that topic. A public stock has a live price. Most of the private companies whose cap tables you put on chain don't trade at all. Yeah. When that equity becomes a token, what actually sets its price? The last round, a secondary bid, or something else? And until there's a real market, can tokenized private equity ever function as on-chain collateral, or is it just a digital share certificate?
Well, that's an interesting point, and I'd like to echo what Joe was saying on the fact that asset might point to the same company, but in reality they don't have the same price. We also saw that with common stocks and preferred share. Like, if you are an investor, you invest in preferred, you have a price. If you're an employee and you get a common, then the 409 evaluation will happen and will basically drop the price of, what, 60, 70% sometimes. So we see that everywhere, whether or not there is a wrapper. I think the question is more like, what is the person entitled to? You mentioned the private companies that are not traded. Of course, they are not, but they are priced by either the round of fundraising that are done. The share has always a price. When you incorporate the company and you do your first authorized shares, there is a price. And then you do a first a corporate action, there is a new price. And this price is anyway monitored. It's the velocity that doesn't exist because it's an illiquid asset. That being said, and that's one of the reasons why we see populating a lot of the pre-IPO project right now. It's because a lot of people want to get access to the wealth that is created in the private markets. And there is no access, period. Like, if you want to be part of Entropic, if you want to be part of OpenAI, like, good luck. You had to be an insider, a happy few, and then you have to wait. So the main question now is more, if it has value, how do we turn that into a potential collateral? And that leads always to the same thing, which is, what is the source of truth? Where is it? Who is maintaining it? Is it unique? And the beauty of blockchain is that those assets that are issued on-chain are programmable. Whatever they are pointing to, they are programmable. And the moment they are programmable, they are on-ramped, and they enter in the whole world of collateralized potential assets. And right now, we work at Fairmint to make sure that precisely whatever the stage of the company, whoever is holding a share in a company, they will be able, if there is a market behind, to tap into a pool of liquidity through a loan if you're an employee, or any other type of liquidity that can be provided. But that's very important. And one of the big opportunities that I see right now in the ability for some layer one to bring TradFi assets to the blockchain is precisely that once those assets become programmable, they will be able to live in any other distribution channel that were built over the last 10 years. So you enter in what, Canton? Fine, you are settled there, but then this asset can become a collateral for something that will move in Ethereum, in Solana, in Sui, in Hedera. And this is the main challenge that we have as an industry today. How do we team up to make sure that we bring interoperability, that we bring trust through standardization. I'll stop here.
Yeah, I mean, like the companies are staying private longer and longer, and they postpone their IPOs like forever. Another interesting angle that we can chat later about is if you know that the stock will probably drop in price and it's not available, and then you use it as collateral with malicious kind of like intentions out there. As we are gearing towards the end of the panel, still, Peter, we wouldn't be in US if we hadn't mentioned the Genius Act and Clarity that is coming. What did Genius, Mika, and Project Guardian unlock in the past 12 months that wasn't possible before? And do you have any take on the upcoming, and maybe not upcoming, Clarity?
Maybe I'll just step back and also say, the whole tone in Washington and the SEC had changed so dramatically that it's enabled all of this. And it started with the administration promoting tokenization. It moved into Chair Atkins saying that it's an American right to hold public securities on-chain in a wallet. And that's really what got, at least on the industry on the public side, saying, okay, the SEC is saying this is something we want to espouse. They created the crypto task force, Commissioner Peirce, encouraging people in the market to come in and talk to the SEC about the current regs, what they want to do with tokens, and where there might be a problem with the current reg. And getting regulation changed in Washington is not easy, and getting no action letters, and DTC got a no action letter. But what we really liked was the SEC said, we'll produce FAQs. If you're a market participant and you want to do something in tokenization, you think there's ambiguity in the law today, tell us about it, and if we support it, and they almost always did because they were rational positions the market was taking, they just put out FAQs. It was easy to do, but it gave the comfort to the industry that they could move forward. The SEC kept talking about creating sandboxes. Go try what you're going to try. If you're unsure, come talk to us. Remember, it's a security, so you can't violate securities laws. And then from that came Clarity. There's been the innovation exemption we've been waiting for a few weeks now. But the nice thing is that the posture in Washington and at the SEC is very supportive of tokenization and letting industry participants try different things. Just don't step over the line and violate the securities laws. So more to come, but it's actually a very good time to be in this market because we've got a supportive SEC.
Brilliant. We could talk over and over, but unfortunately we are up with time. It's brilliant to see that all of the panelists are agreeing in terms of the trend and the direction we are going. It's all a matter of like the implementation specifics and also like the pace at which we are going. And the final aspect of the more friendly environment from the Washington, D.C. is definitely like a headwind that helps us go forward. Thank you very much. Give it a round of applause to our fantastic panel and hope to see you at next year at Tokenize This.
Thank you.